Hey, welcome to our explainer. Today we're going to dig into the one revolutionary idea that underpins pretty much every major company you can think of, from Apple to your local grocery store. It's the engine that drives corporate finance, and I'm not kidding, it literally built the world we live in today.
You see, it all boils down to one simple but really tough question. How on earth do you fund an idea that could change the world but could just as easily bankrupt you?
Okay, so to really get this, we've got to jump in our time machine and head way back to the 17th century. It was a wild time of exploration, massive risks, and, well, potentially even bigger rewards.
So imagine you're an investor back in the 1600s. The spice trade is absolutely booming. I mean, we're talking profits of 400% on a single successful trip. Just incredible. But, and this is a big but, the risks were just astronomical. Your ships had to survive a 7,000-mile journey, dodging pirates, weathering brutal storms, and fending off attacks, all without any modern communication.
And here's the real kicker, something called unlimited liability. What this meant was, if a voyage failed and the company went into debt, creditors could come after everything you owned. Not just the cash you invested. They could take your house, drain your savings, everything. This was a huge barrier. I mean, who in their right mind would risk absolute financial ruin on that kind of gamble?
So you can see how this was a huge problem, right? It basically put the brakes on big, ambitious projects for centuries. That is, until one brilliant idea, a legal and financial game changer, came along and just flipped the whole script.
Okay, so here's the magic. This new idea, limited liability, created a bright, clear line. On one side, you've got unlimited liability. Remember? Your house, your savings, everything's at risk. So of course, you're only going to get a tiny handful of super rich people willing to take that kind of bet. But then you have limited liability, and this is the revolution. The absolute most you can possibly lose is just the money you put in. That's it. Your personal stuff is safe. And that one simple shift, it became the foundation of modern capitalism. It unlocked the power to raise massive amounts of cash from thousands of total strangers to fund these incredible projects.
So where did this idea get its first real test drive? With the Dutch East India Company. It was granted a limited liability charter in 1623. And what happened? The company was suddenly able to raise just unbelievable amounts of money. They built this enormous fleet and went on to completely dominate the Asian spice trade for decades. It worked.
All right, so how does this actually protect you, an investor in the modern world? Well, let's look at a real-world case, Kingfisher Airlines. So an investor buys some shares, but then, the airline racks have about 90 billion rupees in debt and goes belly up. Now, because it's a limited liability corporation, the investor's loss is capped. They only lose what they paid for the shares. The key thing is, the banks can't come after the investor's house or car to pay back that huge corporate debt. That is the power of this idea.
Okay, so we've established that limited liability is the spark that created the modern corporation, but what does the engine of that corporation actually look like? How does it all work?
You know, it's funny. When you strip it all away, all of corporate finance, whether you're talking about a tech behemoth or a small startup, it really just comes down to answering two basic questions.
First up, the investment decision. Pretty simple, right? What stuff should the company actually buy? Are we talking new factories, cool new patents, a whole new product line? This is what the pros call capital budgeting. And question number two, the financing decision. Okay, so how are we going to pay for all that new stuff? Do we borrow the money from a bank? Or do we sell off little pieces of ownership, what we call shares, to investors? That's what's known as the company's capital structure.
And the best place to see how a company answers those two questions is to look at its balance sheet. Seriously, think of it like a financial X-ray. It gives you a perfect snapshot of a company's health, and it all follows one simple golden rule that can never, ever be broken. Assets have to equal liabilities plus equity.
So let's break that down. The balance sheet basically has two sides. On the left, you've got assets. That's all the stuff the company owns. Tangible things you can touch, like buildings and machines, but also intangible stuff, like brand names and patents. And on the right side, that shows how it paid for all that stuff. It's always a mix of two things: debt, which is just borrowed money that has to be paid back with interest, and equity, which is money from the owners themselves, the shareholders, who get a piece of any future profits. And listen, this balancing act isn't just some boring accounting thing. It's the absolute core of a company's financial health. It tells you if it's standing on a solid foundation or if it's teetering on a mountain of debt. But, this whole structure, where you can have thousands, even millions of different owners, well, it creates a pretty fascinating problem. I mean, if the owners are scattered all across the globe, who's actually in charge day to day?
Let's take Apple, one of the biggest, most valuable companies in history. So take a guess. What slice of that massive pie do you think the CEO, Tim Cook, actually owns? The answer? 0.016%. It's a rounding error, an incredibly tiny sliver. And that fact right there brings up a huge question. If the people making the big decisions every day own basically none of the company, are they always really working in the best interest of the actual owners, the shareholders?
This potential conflict has a name. It's a classic idea in economics called the principal-agent problem. It's simple, really. The shareholders are the principals. They're the owners. The managers are the agents. They're hired to do a job. The problem pops up when the agents, the managers, might be tempted to do things that are good for them personally, instead of what's best for the owners. You want a perfect, real-world example of this? Just look at the 2008 financial crisis. The heads of the 3 biggest U.S. car companies flew to Washington, D.C. to ask for a taxpayer bailout. And how did they get there? On 3 separate, luxurious private jets. It was so blatant that Representative Gary Ackerman called it out, saying there's a delicious irony in seeing people fly in on private jets with their hands out asking for money. I mean, that's a textbook case, right? Management is enjoying these lavish perks while the company and its shareholders is on the brink of collapse.
All right, so we've got this corporate structure that allows for tons of owners. But for that whole system to actually work, you need one last, crucial piece of the puzzle. You need a place where all those owners can easily buy and sell their little pieces of the company.
A lot of people think the stock market is just a giant casino for rich people, right? But its most critical job, its real purpose, is to provide one thing: liquidity. That's just a fancy word for being able to easily turn your shares back into cash. It means any of those thousands of owners can sell their stake to someone else, quickly and easily. And think about it. If you couldn't easily get your money out, would you ever be willing to put it in? Probably not. And the sheer scale of these markets, it's hard to even wrap your head around. Just to give you some perspective, back in December 2015, the value of all the companies on just the New York Stock Exchange was about $17 trillion. At the same time, over on the Shanghai Stock Exchange, they were seeing something like $87 billion worth of shares traded not in a year, not in a month, in a single day. This is the massive financial engine that makes it all possible.
So that's how all the pieces click into place. You have limited liability, which takes away that catastrophic personal risk. You have the corporate structure, which lets you hire professional managers to run the show. And finally, you have the stock market, which provides the liquidity that convinces millions of people to invest their savings. It's that powerful combination that allows us to fund the kind of massive, risky, world-changing projects that have defined the last couple of centuries.
But all of this leaves us with one last really important question to chew on. This whole system, the entire idea of the corporation, was designed from the ground up to limit risk and create wealth for its investors. So, in the world we live in today, with all of its complex challenges, what is the responsibility of these incredibly powerful corporations to the rest of us, to society as a whole? It's definitely something to think about.